Welcome back. Right, in this section we are going to start looking at the candlestick patterns and some of the types of candlestick that you need to be aware of. So firstly, we are going to focus on bearish candlesticks. So we are going to briefly summarize the structure of a bearish candle. Then we are going to highlight types of bearish candlesticks, and then we'll conclude the section. So a brief summary of what we have already covered, but in particular a bearish candlestick. So bearish candlesticks indicate the market is moving in a downward trend, and if you need a way to remember this easily, think of a bear trying to sweat down a beehive for some honey, only that you are a trader and you're trying to sweat some pips into your profit and loss statement to help you see a return sweeter than honey. Now, what makes a candlestick bearish? You guessed it, black colored candlesticks. As of this course, we are going to be using black colored candlestick for our bearish candles. Once you spot one, make sure it follows the same body wick ratio that we talked about for bullish candlesticks, meaning it needs to have a bigger body. The body rule still holds true for bearish candlesticks, except this time we are in a downward momentum. Guess what they say is true? The bigger they are, the harder they fall. As we have mentioned already, the structure of a bearish candle is as follows. We've got the opening price. This represents the opening price of the candle, and the bearish candle opens higher. And we've got a closing price. This represents the closing price of the candle at the time of the candle close, and this price is lower than the opening price. So for instance, if we say Euro USD on a monthly chart opened at $10 and then it closed at $9, that means that whole month was bearish with 100 pips on offer. Then we've got the body. The body represents the price range between the open and the close of that time frame. Then we've got low. This represents the lowest price point reached during the time frame of the candle. I don't need to keep repeating this, guys, you already know what it is, but I'm only doing it so that it sticks in your head because this is very crucial information. Then we've got the high. This represents the highest price point reached during the time frame of that candle. And then we have the lower wick and the upper wick. These represent the extended price action above and below the candle's body. The length of the wick indicates the high and the low price points of that time frame. So now let's take a look at some types of bearish candlesticks. Now that you know and understand what is a bearish candlestick, it's time we move further and discuss the types of bearish candlestick and patterns that you are mostly likely to find on the candlestick chart. There's a wide variety of bearish candlestick types and patterns. In this section, or in this course rather, we are going to focus on the following bearish types. Number one, we're going to looking at the shooting star. Then we're going to look at the evening star. Then we've got the bearish engulfing candle, one of the most powerful candlestick pattern out there. Then we've got the dark cloud cover. And then we've got the tweezer top. Then we've got the bearish pin bar and the bearish harami. These are the candlesticks that I've decided to highlight and teach to you guys because I've been using them and I've seen how they work and how often they are formed on the chart. Candlesticks should provide different visual clues that make understanding price action easier. Different time frame trading with candlestick chart allows traders to better understand market sentiment. In my opinion, candlestick chart offers a greater depth of information than a traditional bar or line chart. In the bar charts, high and lows are emphasized more than anything else, while candlesticks give emphasis to the relationship between the price, the opening price, and the closing price. Traders who use different candlestick patterns should identify different types of price action that tend to predict reversals or continuations of trends. Additionally, when we combine them with other technical analysis tools, we should get an accurate estimate of possible price movement. Like all candlestick formations, if you see it bouncing off a supply or demand, you might assume it is pretty reliable, but don't rely on just candlestick formation. Back it up with other tools and create your own trading zone. So now let's look at the bearish candles that I've highlighted above. Firstly, we're going to look at the shooting star. What is a shooting star? This is a bearish shooting star is a 2 candlestick pattern that signals a warning of an impending top or high in the market. The shooting star tells us that the market opened near its low, then strongly rallied and finally reversed off to close near the opening, thereby showing us that the session's rally was not sustained, as you can see on the illustration. During an uptrend, take note when price approaches a strong area of supply or a resistance zone. When you see the illustrated candlestick pattern, the one on your right, sell in the direction of the trend at the beginning of the next candle, or when it fulfills the criteria of the bearish shooting star. You place your protective stop loss at least 15 pips above the high as illustrated. As you can see, I have illustrated a shooting star. We've got one strong bullish candle that pushes into an area of supply or resistance. Then we've got a bearish candle which shows us a huge rejection on the wick. You can see the wick is longer than the body of the candle. That's showing us a rejection of higher prices. So you need to sell when this bearish candle opens, whether it's opening bearish or it opens bullish. This is your entry point to sell to the downside. Now let's look at a bearish evening star. A bearish evening star is illustrated by a doji spinning top type candle which appears at a high or a peak in market structure. This is a very strong bearish reversal pattern. So you must understand that when you see or when you're in a position to identify an evening star, take note of where price is in relation to market structure. If we are at a strong supply or a resistance zone on a higher time frame, say daily or weekly or monthly, and then you see an evening star formation, that is a very strong bearish reversal patterns which signals to you that okay, price they're gonna start moving to the downside. So during an uptrend, take note when price approaches a strong area of supply or resistance zone. When you see the illustrated candlestick pattern, sell in the direction of the trend at the opening of the next candle or when it fulfills the criteria of a bearish evening star. You place your protective stop loss at least 15 pips above the high as illustrated. One thing to take note of The close of the bearish candle, the second bearish candle in the pattern, must be beyond 60% down 10 of the last bullish candle. Now let's look at the bearish engulfing candle. This is one of the most powerful candles pattern that you can use, and a more reliable pattern in terms of price action. The bearish engulf pattern is a major reversal signal with two opposite color big-bodied candles comprising this pattern. So remember, a bearish engulfing candle is represented by two candles, two big-bodied candles. One has to be green, one has to be black. The close of the bearish candle must be beyond 65% 10 to the downside. Remember guys, we are only talking of bearish candles at the moment. So you'll find out that most of the signals that are derived from these candlestick types are sell signals. Consider the following criteria to qualify a bearish engulf pattern. The market structure has to be in a clearly defined uptrend at either a supply zone or a resistance zone. The second body of the pattern should be bearish candle with a strong momentum to the downside. Two candlesticks make up the pattern. The second real body must engulf the prior body. Wicks are not much of a priority to the engulf, so you must always take note if the body of the bearish candle that forms after the last up candle has engulfed the previous green candle. When you see the illustrated pattern after the engulf bearish candle appears in the direction of the trend, sell at the opening of the next candle with a protective stop loss approximately 50 to 20 pips above the highs of the wicks. Now let's look at a bearish dark cover. This is a very rare bearish pattern. It normally appears at high depicted by bearish candle body closing higher and closing the body at least 60% down previous bullish candle. This is a very strong reversal pattern comprised of two candlestick pattern that is formed at a high or a supply zone after an uptrend, or at the top of a consolidation zone at a supply zone. When you see the illustrated pattern, sell in the direction of the trend at the opening of the next candle, or when it meets the criteria of the bearish dark cloud cover with a protective stop loss approximately 15 to 20 pips above the highs of the week. Now let's look at a bearish tweezer top. Tweezers are two or more candlestick pattern with matching highs or lows. During a bullish market, a tweezer is formed when the highs match. As you can see on the illustration, the highs, which are the highest price point including the week, they're almost equal, more or less same price point. When you see the illustrated pattern, after you have two candles that have met the criteria of a tweezer top, sell at the opening of the next candle with a protective stop loss approximately 15 to 20 pips above the highs of the week. Now let's look at a bearish pin bar. A bearish pin bar signals a very strong rejection. It signals a very strong bearish signal on a break below. It's illustrated by sellers pushing the bulls lower on a candle, forcing a large wick and visually showing us traders' rejection of higher price. As you can see, the highlighted green candle in the middle, you can see that it has got a very long wick. That means at one point during that candle's formation, whether it's on a 15-minute or 30-minute time frame, at one point it was a solid green candle to the upside. But prior to its closing, the sellers or the bears, they pushed price further down, meaning they won the tussle, they won the fight. They pushed price further down, thereby forming that long wick. When you see the illustrated pattern, sell at the opening of the next candle with a protective stop loss approximately 15 to 20 pips above the highs of the wick. Take note, the wick should be at least 60% of the body size. Now let's look at the bearish HARAMI. The HARAMI pattern is a small real body which is contained within a prior relative long bullish body. HARAMI is an old Japanese word for pregnant. The long bullish candle is the mother. The long bullish candlestick is the mother, regarded to as the mother. And the small bearish candle is regarded as the baby, thereby depicting a pregnant woman. The HARAMI pattern is the opposite of the engulfing pattern. It's not much of a strong reversal pattern, so you need to be really careful when you are in a position to have seen a HARAMI formation on a market structure. It's not that much of a strong reversal pattern. A bearish HARAMI appears at a high or a consolidation point in the market. A break below the bearish candle indicates a potential bearish move to the downside. When you see the illustrated pattern, sell at the opening of the next candle with a protective stop loss approximately 50 to 20 pips above the highs of the wick. So, to conclude the bearish candlestick types, there are only two groups of people in the forex market. They are buyers and sellers. We want to find out which group is in control of price action at the moment. We use candlesticks to figure that out. So when you open your chart, you need to be in a position to identify who is in control of the market. Are the bears in control? Are the bulls in control? You look at the size of the body of the candles. Wide range candles state that there is high volatility, interest in the currency pair, and narrow range candles state that there is low volatility, little interest in the currency pair. Low volatility leads to high volatility, and high volatility leads to low volatility. So in order to keep your account safe during the period of high volatility, you should analyze candles themselves. In the next section of the course, we will be looking at bullish candlestick types. I'll see you in the next section. Thank you.